Hello and welcome to another episode of this special series, Get Started in the Market, where we help you understand the basics of stock market investments. In today's episode, we'll tell you the various ways you can invest in equities. But before that, here's a quick recap of our last episode. Let me take you through how an exchange really works.
An exchange is the main trading platform through which you buy or sell listed shares. The largest stock exchange in India is the National Stock Exchange. The exchange uses a trading system, which is an order-driven automated matching system. At any point of time, there might be many buyers and sellers of the same stock in the market. If your order does not find a match, it remains in the system and is displayed to the whole market till a fresh order which matches comes in or the earlier order is cancelled or modified. The shares that you buy will not immediately reflect in your demat account, as the NSE follows a rolling settlement on the T+2 basis, which basically means if you place an order on Monday, it will get settled by Wednesday. So how does the exchange ensure that all transactions are honoured at the price they were struck? This is where the margin system comes in. If you buy 1000 shares of a company at 100 rupees per share, the total amount that you owe your broker will be 1 lakh rupees. You would first need to make an advance payment to the broker to lock this transaction. This advance amount is called a margin. So in this case, if the upfront margin payable is 10%, it would mean you will need to pay 10,000 rupees at the time of striking the deal.
So till now, we've told you how you can buy stocks which are already in the market, which is called secondary market investments. But there are other ways to invest in stocks as well. Let's take a look at some of them. You can buy individual stocks from the secondary market, which we've already discussed. You can invest in the initial public offering of a company at the time of listing, or you can even buy into its follow-on public offering. You have the option of investing through the mutual fund route, which is one of the most popular ways of investing in the stock markets, and you can also buy into exchange-traded funds or ETFs.
So let's start by understanding the most popular route of stock market investments, the mutual funds. What is a mutual fund? In simple words, a mutual fund is a pool of investments into stocks, bonds, commodities, or a combination of securities, which is managed by a professional. These mutual funds are managed by asset management companies or AMCs, which are registered with regulatory authorities and are licensed to offer these products to investors. So let's understand this with an example. Supposing an AMC announces a new mutual fund offering, and 10 investors decide to put in 1000 rupees each in this mutual fund. So each of these investors will hold 1 unit of this fund, and each unit's face value will be 1000 rupees. This is also called the net asset value or NAV. Once this pool is ready, based on the type of fund that you have selected, the fund manager will then decide what portion of these funds to invest in stocks, what in bonds, and what remains in cash. This portfolio of a mutual fund is also known as assets under management or AUMs. So how does the value of your mutual fund move up or down? Let us suppose the investments of the fund manager worked well, and after 1 month, the value of this portfolio has moved up to 11,000 rupees. This would mean each of the investors will equally gain 100 rupees, and the net asset value of each unit will now move up to 1100 rupees. You can invest in a mutual fund in a lump sum manner or in smaller regular amounts through a systematic investment plan or an SIP. This will depend on your capacity to invest. To understand mutual funds better, let's go across to the MD and CEO of ICICI Prudential Asset Management Company, Mr. Nimesh Shah.
Thanks very much for joining us, Mr. Shah. My first question to you is, how does a systematic investment plan work and what are its benefits?
The first thing is, when you are investing in equity, you have got 2 choices. So in a mutual fund, whether you invest it one time, whether you say, I invested one shot, I've got a sum of money and I want to invest it today, you invest it today. But then you are not sure whether the markets are going to go up, markets going to go down. So if you want to remove those uncertainty of timing, what people do is that people come in parts. Every month you keep on investing, so you average out your cost. So if the markets go down after that also, in 3 months time, if you are investing it every month, then as the market goes down, you are further investing. So over a period of time, your cost gets average out. So that is the reason of people going for systematic investment plans, that every first of the month or every third of the month or every seventh of the month you keep on investing a fixed set of money for the next 2 years, 3 years, 5 years, 10 years, depending on your goal. So we always say, look at what your final goal is. If you want to buy a house, then every month how much I should be investing.
There are different types of funds in a mutual fund. So you have equity funds, you have diversified funds, mid-cap, large-cap. So as an investor, how should one decide which fund to invest in?
See, for investors, it is best that they come into diversified equity funds, because over a period of time, your investment is diversified. So when we say NICC Prudential Dynamic Fund, what does it do? It invests in various industries. It does not invest in a sector fund will invest, say, in infrastructure. Then it will invest only in capital goods industry, or a banking fund will invest only in banking. For first-time investors who come into mutual fund, it is best that they come into diversified funds. So there is investment across various sectors.
So assume an investor does not want full exposure to equities. What kind of a fund can he invest in to reduce his risk?
See, there is another category of funds which is called a balance category. So we have modulated it slightly so that it takes part equity and part debt. So basically what is the problem? That the retail investors comes in when the market is very high and goes away when the market is very low. That is a problem that has happened. So what we do in this fund, we take money at any point of time. This fund will invest part in equity and part in debt.
Okay.
That is, so today around 50 to 55 rupees it will invest in equity, remaining it will invest in debt. But suppose the market goes up, then they will reduce their equity exposure. Exactly reverse of what a retail investor will do.
Okay.
And when the markets become cheap, suppose the market goes down, then they will increase their equity composition.
What is the difference between a growth option and a dividend option? And how should one decide which one to opt for?
Actually, return-wise, it does not make any difference. It's a question of whether you want your money back at regular intervals or you would take the money back only when you sell the mutual fund. So there are two types of people. My father would invest in a dividend option so that he gets return every month or every quarter or every year the way he wants it. So there are some people who go for dividend option where they want regular return every year. And there are people like me who are earning today, so their salary is supporting them today, so they don't need that returns every month, so they go for growth option.
What are the kind of fund management charges or commissions that are charged for mutual fund investments?
If you give me 100 rupees, I buy shares worth 100 rupees for you. There is no packaging involved in that. And there is a fixed charge per year that is charged to the customer, and it is a very it is around 2% or 2 to 2.5% based on the level of the fund. It is 2 to 2.5% is charged to the fund, and it is a very transparent system before you get into the fund, and that is the only charge. There is no other charge that comes on the investor. And in some funds, if he goes away before 1 year, suppose he decides, then there is a slight of an exit load which is 1% or something. If you invest in a Nifty directly, you don't need any expertise to, you can straight away go to the markets and buy Nifty, right? You get whatever, if the Nifty goes up by 20%, you get 20% return. So when we are active fund managers, as we are called, what we do is that we manage money on your behalf. So after our charges, do you get an incremental return? We are paid for to beating the benchmark.
And finally, my last question, what are the kind of tax benefits that one gets from mutual fund investments?
See, there are two things. One is when you invest in a mutual fund, you get that ATC benefit that has recently been increased also. But for that, you have to invest in some specific ELSS schemes, as they are called. If you invest in ELSS schemes, then you get that tax benefit in that one. But otherwise, there is another benefit of investing in mutual funds, that if you invest in an equity mutual fund, if you remove money after 1 year, there is practically no capital gains that comes onto a mutual fund. One is that you get, if you invest in those tax benefit schemes, you get that. But otherwise, after 1 year, if you sell, if you have taken units worth 100 rupees today, and they are worth 120 tomorrow, that is after 1 year, if you remove them, there is absolutely no taxation on that.
So now that you understand what mutual funds are, let's move on to the next investment tool, the exchange traded fund or ETFs.
ETFs have some common characteristics with both individual stock trading and with buying a mutual fund. A typical ETF tracks an index like an index fund, but is traded on an exchange like a stock. So an ETF is like buying a specific index, but instead of buying each and every stock in an index, you are just buying a single fund, which stands for the underlying stocks in the index. For instance, a Nifty-based ETF will have all the stocks of the Nifty more or less at the given weightage of those stocks in the Nifty index itself. An ETF simply tries to mimic the overall movement of an index. If the Nifty goes up, the Nifty ETF tends to go up at the same rate and vice versa. Unlike mutual funds, but like for buying specific stocks, you will need a demat and broking account to buy ETFs. So for example, if you want to buy one of the most popular ETFs in India, called the Goldman Sachs Nifty Bs, you will place the order to buy these ETFs with your broker, who in turn will buy it from the exchanges. And once the transaction is complete, these ETFs will reflect in your demat account. But the underlying stocks of this ETF will be owned by Goldman Sachs, who is the sponsor of this particular ETF. Let's find out more.
What are the positive and negatives of exchange traded funds? If you can take us through that.
Many investors in the mutual fund, normal mutual fund, get a day-end NAV. If you want to exit or enter into particular situation in the market, during the day there might be certain changes in the market. As you see the stock market, sometimes it fluctuates by -5% during the day and comes back to 5% plus during the end. If you are an end day investor in a normal mutual fund, you get the end day NAV. In an ETF, you can enter at any point of time, you can see the market, time the market and just buy the units. That becomes one of the biggest positive. The negative side, if I say, the cons of ETF is most of the ETFs are primarily index based. There is an underlying index which they track and try to reduce the expenses. So there is no active fund management. There is no value addition from the fund manager side. So because of that, you are always tracking the market return. You are not getting anything beyond the market return.
Okay. So you spoke about active management. So that brings me to my next question. What is the difference actually between, other mutual funds and ETFs specifically?
The difference between ETFs and a actively managed fund is that, it tracks the index. Suppose I am trying to invest in Nifty. I can either buy a Nifty future option or something, and if you want to invest in for long term, you can buy a Nifty ETF. So the exchange traded fund is a typical unit listed in the stock exchange. You buy that. It follows the same proportion of ETF, and what it does is it can perform according to the market. The active fund manager does a lot of value addition. Out of the Nifty 50 stocks, there might be 10 stocks which are laggards. There are 10 stocks which might be outperforming the Nifty. Active fund manager will throw out those 10 and pick those 10 better ones, increase the allocation to them. In case of a ETF, you don't get that benefit.
And as far as the tax implications are concerned, what is it for ETFs and the difference between other mutual funds and ETFs?
As of now, the ETF's tax implication is as per the underlying asset. So if you are buying a gold fund from normal mutual fund versus a gold fund from ETF, the tax implication will be the same. If it is a debt fund, be it in the ETF category or normal mutual fund category, up to 3 years, there will be short-term capital gain, and above 3 years, it will be long-term capital gain. And similarly, on the equity fund, below 1 year, it is short-term capital gain, taxed at 15%, and above 1 year, it is taxed at 0 tax because it is a long-term capital gain. So typically, ETFs do not provide any extra benefit from tax point of view.
What are the kind of investors who should look at investing in an ETF?
Okay, this is very interesting. I see a big trend emerging worldwide. A lot of investors in last 5 years have been going for ETFs because people thought that the opportunity in the market is limited to create alpha because of a fund manager, and the fund managers haven't delivered extra outperformance in last 5-6 years. In India, since it is an imperfect market, that hasn't happened. In India, fund managers still do a lot of value addition by doing extra research. In case some individual investor goes to a normal fund, there is a minimum investment amount, a 5,000, 10,000, 20,000. In ETF, that is not there. ETF, you can just buy one single unit. If you got a demat account, you can just buy 1 unit of any ETF. Second is you get all the asset classes in one platform, a stock exchange platform. So you can buy gold, debt funds and equity and ETF. But primarily ETFs are good for institutional investors. For retail investors, they still need assisted advice. They should get some help in selecting the asset allocation, selecting the underlying scheme. In ETFs, because it is real time, many times advisory is not there.
Time for a short break, but when we come back, we'll tell you how you can buy the debutante stocks of a company through its initial public offering or an IPO.
These are visuals that you must have seen many times. The ringing of this bell changes the status of a company from a private limited company into a public listed one, which means anyone from the public can now bid and buy the stock of this company.
But you can buy these stocks even before they get listed, or rather apply to buy. And how do you do that? You do it by investing in the initial public offering or the IPO of a company. Let me take you through this process.
Once a company gets all the regulatory approvals to launch its IPO, it comes out with its IPO prospectus, which is a detailed document about the company. It aims to introduce the company to its potential investors, details its finances, its track record, and its future plans. It is also mandated to contain full disclosure about any potential liabilities of the company, including those under litigation.
Once you decide on the IPO you want to subscribe to, you will need an application form such as this. This form is available online with your broker or even your banker. Every application form has to be set for a minimum number of shares, which you need to submit along with a check for the total amount of shares that you are applying for. In case the number of shares allotted to you is less than the number of shares that you had applied for, the remaining amount will be refunded to you. Remember, you do need a demat account for this.
But why should you opt to invest in an IPO rather than buy the shares after they are listed? Companies are usually fairly valued in their IPOs and are available at a discount to retail investors, but getting an allotment of shares in IPOs for retail investors is usually not that simple, especially for companies with good fundamentals, as the IPO tends to get more demand than the number of shares that are actually on sale. In this case, shares are allotted on a pro rata basis, or lots are drawn and only few retail investors get shares allotted to them.
Typically, the merchant bankers who advise the companies, they would look at the traditional valuation models, and they would also look at the current market mood and the peer group. And based upon these factors, the merchant bankers would do then some pre-IPO marketing, talk to some institutional investors, get a sense of their comfort with the price levels, and then finally announce a price band. After consultation with some institutional investors through pre-IPO roadshows, a price is finally discovered and then announced to the market. An IPO can be either for fresh capital, which is basically raising money for the company, or it could also be in a company where the existing shareholders are doing a divestment, where no capital is coming into the company, but the proceeds of the issue go to the selling shareholders. That is an offer for sale, a pure offer for sale. So a company which is already listed through an IPO also has an option of doing a follow-on public offering, basically which means that you are inviting public at large to again come and invest in that company's shares. So a follow-on public offering can be either again for raising of capital, fresh capital, or it could be a divestment from an existing shareholder where the company is already listed. For example, there are cases of Government of India companies, PSUs. The government may divest 5%, 10% stake in an already listed company. I've been telling all small investors who come and approach me is that IPO is the riskiest form of investing in equity. If you want to invest in equity, it is better to research, understand and buy an already listed stocks, because there is a lot of disclosures already about that company. The price has been discovered by the market collectively. In IPO, as we know, nothing is known about the company except through the offer document. An offer document is typically a seller's offer document. Number two, there is no validation by the market of the price, and therefore you are at sea about how good or bad the price is. Nevertheless, IPOs are a good investment opportunity. There have been hundreds of IPOs which have given huge returns to investors, and therefore try to read as much in the prospectus and from other sources to know more about the promoter and his company, his track record, his compliances. Has he been convicted for any crime or any offense? But if institutions have supported the IPO significantly, in case there is a huge oversubscription in the QIB portion, then the retail investors can ride on the back of the diligence both on the company and the pricing done by the institutional investors. For a retail investor, it is good for him to look at the QIB book and the levels of subscription before he takes a final call on applying.
Now that you know the various ways of investing in equities, be it via a mutual fund, an ETF or via an IPO and FPO, here's a quick look at the various modes that you can use to trade in the stock market.
Did you know you can trade online, offline and even through your mobile phones? Offline trading requires a client to call or actually visit a branch of their broker to place an order. The commission tends to be higher. Online trading requires you to simply have access to the internet. You can directly log onto the website and start trading from wherever you are. For mobile trading, all you need is an internet-enabled phone and a trading platform or an app which will be provided by your broker.
With that, it's a wrap on this episode of Get Started in the Market. We'll be back next week to tell you what you need to know after your trade has gone through. Thanks for watching.